Property tax relief is another one that varies heavily depending on where you live, but it is worth checking no matter what state you are in. Many counties and states offer some form of property tax reduction, freeze, or exemption specifically for senior homeowners, especially those on a fixed income. The challenge is that these programs are almost never advertised. You usually have to actively apply through your local county assessor's office. Nobody mails you a flyer. Nobody calls to remind you. If you have lived in the same home for years and never looked into this, it might genuinely be worth 20 minutes of your time to check your local county website. For anyone who is charitably inclined, there is a strategy called a qualified charitable distribution that lets you donate directly from a retirement account, like an IRA, straight to a qualifying charity. The advantage here is that the donated amount can be excluded from your taxable income entirely, which is different and often more beneficial than a regular itemized charitable deduction. A lot of retirees who give to their church, a local community organization, or a cause they care about are doing it the old-fashioned way, writing a personal check, when there might be a more tax-efficient way to give the exact same amount and end up better off financially because of it. There is also something worth knowing about capital gains. For retirees whose taxable income falls under certain levels, long-term capital gains can actually be taxed at 0%, not a lower rate 0. This means if you are sitting on investments that have grown over the years and you are in a lower income bracket during retirement, there might be a window where you could realize some of those gains without owing federal tax on them at all. This is incredibly underused, mostly because people assume any investment gain automatically triggers a tax bill, and that simply is not always true. Here's the bigger picture behind everything we just covered. None of this is about doing anything risky, aggressive, or even slightly questionable. Every single one of these is a normal, legal, completely above-board part of how the tax system already works. The problem has never been that these benefits don't exist. The problem is that the system relies entirely on you, or whoever is preparing your taxes, knowing to look for them and apply for them correctly. There is no automatic alert. There is no IRS agent assigned to make sure retirees are getting everything they are entitled to. That responsibility sits with you, and honestly, that is exactly why we make videos like this one. So what should you actually do with this information? Start simple. Pull out your most recent tax return and actually look at it, not just glance at the bottom line number, but really look at what was claimed and what wasn't. If you work with a tax preparer, ask them directly whether the additional standard deduction for your age was applied, whether the saver's credit could apply to you, and whether it is worth reviewing your last 2 or 3 years of returns for anything that might have been missed. If you handle your own taxes, it might be worth a single consultation with someone who specializes specifically in retirement income, just to get a second set of eyes on your situation. Sometimes one conversation is all it takes to uncover something that has been sitting there unclaimed for years. Margaret ended up working with a specialist, and across her review and her current year filing, she found enough in missed credits and an amended refund to genuinely surprise her. Your situation will look different, it always does, because everyone's income, state, and filing history is different, but the lesson is the same no matter who you are. Money that is legally yours does not become unyours just because nobody told you about it. It just sits there, unclaimed, until somebody asks the right questions. If this video gave you something useful today, do us a favor and drop a comment below letting us know which one of these surprised you the most: the additional deduction, the saver's credit, the state tax differences, or the amended return window. We read every single comment, and it genuinely helps us figure out what to cover next. And if you know someone, a parent, a neighbor, a friend from church, anyone who is retired or getting close to it, go ahead and share this video with them. This is exactly the kind of information that is more valuable shared than kept to yourself. Thank you for watching Retire Rich News. Hit subscribe if you haven't already, and we will see you in the next one. If you've turned 65 and you're still filing your taxes the exact same way you did at 40, then the IRS is probably sitting on money that is legally yours. Right now, today, there could be hundreds, maybe even thousands of dollars in credits and deductions that nobody at the IRS is ever going to pick up the phone and tell you about. Nobody is going to mail you a letter that says, "Hey, you forgot to claim this." That is not how the system works. The system is built so that if you don't ask, you don't get. And by the end of this video, you are going to know exactly where most retirees are leaving money on the table and exactly what to do about it before another tax season slips by. Welcome back to Retire Rich News, the channel built for one simple reason: helping you keep more of the money you spent your whole life earning. If this is your first time here, stick around, because what we cover today could be worth more to you than anything else you watch this week. Let's start with a story. Margaret is 67 years old. She worked as a school administrator for almost 30 years, retired with a modest pension, some Social Security, and a small IRA she had been adding to since her 30s. Every year, she went to the same tax preparer, handed over her paperwork, and trusted that everything was being handled correctly. And technically, it was. Nothing illegal was happening. But here's the thing nobody told Margaret. Because she was using a standard basic filing approach, she was missing out on benefits that exist specifically for people her age. Not loopholes, not tricks, just normal legal provisions written into the tax code that are simply easy to overlook if you are not specifically looking for them. The first one, and this is the one almost nobody talks about, is the additional standard deduction available to anyone 65 or older. Most people know about the regular standard deduction, but very few realize that once you cross that age line, you qualify for an extra amount on top of it. And if you are married and both you and your spouse are over 65, that extra amount applies twice. For a lot of retired couples, this single adjustment alone can lower their taxable income by a meaningful chunk, which means less money going out the door to the IRS every single year. And the frustrating part is, this is automatic only if your tax preparer or your software actually applies it correctly for your exact filing situation. Plenty of people get shortchanged simply because of a small clerical oversight. Then there is the saver's credit, and this one genuinely surprises people. If you are still working part-time in retirement, even just a little, and you are contributing anything to a retirement account like an IRA, you might actually qualify for a direct credit on your tax bill, not just a deduction. A deduction lowers the income you get taxed on. A credit lowers the actual tax you owe dollar for dollar. Most retirees assume credits like this are only for younger workers just starting their careers. That assumption costs people real money every single year. Here's something else that catches a lot of retirees off guard, especially if you've moved states recently or you're thinking about it. Many states do not tax Social Security benefits at all. Some don't tax pension income either, but people retire, relocate to be closer to grandkids or for the weather, and never go back and check weather. Their new state treats retirement income differently than their old one did. We are not talking about federal rules here. This is state level, and it varies a lot more than most people expect. If nobody has sat down and compared your specific state's rules against where you used to live, you genuinely might not know if you are paying more than you need to. Now let's talk about something that FLIs almost completely under the radar: Medicare savings programs and extra help for prescription costs. These exist for people whose income falls under certain limits, and a surprising number of retirees who would actually qualify never apply simply because they assume programs like this are only for people in serious financial hardship. That is not necessarily true. The income thresholds are often higher than people expect, and even partial qualification can mean real monthly savings on premiums and medications that add up to a significant amount across a full year. If you're still with me, and I really hope you are because we are just getting started, do me a quick favor. Hit that like button right now, and if you haven't already, go ahead and subscribe to Retire Rich News. We put out new videos covering exactly this kind of practical, real-world money information, the stuff that actually affects your wallet, not just theory. It genuinely helps the channel reach more retirees who need to hear this, and it takes about 2 seconds. Okay, let's keep going, because there's more, and some of this next part might apply to you directly. Let's go back to Margaret for a second. After sitting down with someone who actually specializes in retirement tax planning, she discovered something else most people never think to check: whether she had any unclaimed refunds sitting from previous years. Here is something a lot of people don't realize: the IRS generally allows you to go back and claim a refund for up to 3 years after the original filing deadline. That means if a mistake was made or a credit was missed 2 or even 3 tax seasons ago, it is not necessarily gone forever. There is often still a window to file an amended return and recover what should have been yours in the first place. Margaret had no idea this was even possible. She assumed once a tax year was filed, that was the end of the story. It is not always the end of the story.